Hello, everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I'll be your host today. I head the G10 FX strategy team here in the US, and I'm happy to be joined by Paul Robson, who heads the G10 FX strategy team over in London to talk about all things G10 currencies this week. So, Paul, thanks very much for joining.
Well, thanks for the invitation back after a little bit of a summer break. So very much looking forward to going through recent central banks and what it might mean for currency. So once again, thanks for the invitation.
Yeah, it has definitely been a busy start to the month of September. And as we're recording here on Thursday morning, the ECB decision just happened. And so it's pretty fresh in our minds. So I want to start there. What did the ECB do today? And was there anything surprising in the details of what we heard from the ECB?
I wish I could say it was a super interesting meeting, but I'd just be lying. It was very much in line with market expectations. The ECB cut interest rates by 1/4%. That was fully priced, so very little in terms of surprises. The forecasts were a little bit higher than I think some people expected, both growth and inflation. I think they probably didn't want to get into a 25, 50 basis point cut discussion by the end of the year. I think maybe they've been looking over the Atlantic to the Fed and the discussion. I'm sure we'll get onto that in a moment. So, but relatively cautious set of forecasts probably stops people pricing in significantly more easing by the end of the year. And it's a similar kind of thing from the press conference. Sometimes the statement and the press conference are slightly different, but they're all very consistent as well. The risk to growth was said to be to the downside. I think that most people would have expected that, but in true sort of economist fashion, on one hand, growth a little bit weaker, on the other hand, inflation a little bit stronger. So the message was, please don't read too much into this about the chances of October cut, and the ECB very much data dependent. I think for the outlook for the ECB, where I think there's going to be interest over the next couple of quarters is where is the ECB ultimately heading? I would call that terminal rate in this easing cycle. So basically, where are they going to be finished? And here, I think markets are quite dovishly priced. We're a little bit more cautious. We think that the ECB will cut fairly steadily through next year. There's no rush, there's no urgency, there's no panic from the ECB. But ultimately, we see them stopping just over 2%. The market has got them continuing to ease. So I think that might be something to focus on in months ahead.
That's a really good point, that the end of the cycle just as important as the start of the cycle, certainly when we think about the Fed, but for the ECB as well, and also the pace of the cycle. There's, every piece of this easing cycle is going to be important for FX markets and for the euro. And so let me just ask you that. It doesn't sound like from your initial description that this meeting was really a game changer for the euro, but what are you thinking about the euro here as we consider the ECB and where the ECB sits relative to its peers?
Yeah, I completely agree with you. I don't think it's the time to be banging the drum on looking for a significant move in the euro either. Straight after this decision over the coming days, as people adjust their expectations, or even the next couple of months, as they said, this was largely as expected. I still think the euro does a little bit better, say, against the dollar. Obviously, we're going to talk about the dollar and the Fed in a few moments, but given that market pricing for that terminal rate I was talking about, that endpoint of the ECB easing cycle, where we don't think it's going to be quite as low as markets, and as I'm sure we'll discuss later, maybe the Fed cuts a little bit more aggressively early, and ultimately that supports euro dollar. But I think there's some more important stories. I mean, almost elephants in the room, if you like, over the long-term direction of euro dollar. Political stability risks. I mean, that's going to be something that we're going to be coming back to, I would think, quite a lot over the coming sort of 6 months or over the year. Deindustrialization of Europe, just still some very challenging times for Europe. And, what's the political response to that, and what happens if rates of growth stay weak or in contraction, and how does the ECB react to that, and ultimately how that will move euro dollar. And also, like a lot of economies, fiscal policy. Europe has got high deficits. How are they going to treat those? Now, it's a similar kind of story here in the UK and the US, other economies. But I think those three things, that's what's going to cause the uncertainty, I think, about the outlook. And when you put it into, I think you've got a presidential election just sort of coming into sight. We'll talk about that later, obviously. But yeah, lots of potential for volatility, I think, in euro dollar. I think we've got used to euro dollar not doing very much over the last couple of years. And I think that may well change over the next 6 months.
When you spoke about manufacturing just a second ago, what jumped into my head was, if we get a change in the administration here in the U.S. and potentially a big push towards tariffs, and what that could mean for manufacturing cycles, not just in Europe but across the world, and how that sort of conflicts with a potential easing cycle that we have, which would normally be kind of a good thing, I think, for for cyclically linked, manufacturing cycle. So super interesting as we try and sort of parse all these together. But I do want to touch on, you mentioned Bank of England and the UK outlook. We do also have the Bank of England next week. Looks like their decision, I see, is just one day after there's the CPI print coming out in the UK. What are you thinking for the Bank of England? Do you think we'll get anything more exciting than maybe we got from the ECB today?
Unfortunately not. Actually, I wish I could say that we were expecting a big surprise. You never know. CPI, some of the data, that was to be a big surprise, but anything other than unchanged rates at 5% would be a big surprise, even a shock to markets. We give a 10% chance that they cut interest rates that little bit earlier. We think ultimately they cut in November, and that will be pretty much done for this year. We still think interest rates will go lower next year. But actually, just with the ECB, that terminal rate discussion, I think, is going to be important for the currency. Maybe we can talk about that. As usual, there'll be some moving parts to it. So people always seem to be obsessed by the vote count, and we think that that's going to be 7-2 in favour of unchanged rates. So 2 people voting for further cuts. That could easily be just 1, or it could be 3. And sterling might be a little bit sensitive to that. Overriding sort of shifts in guidance, hints about where interest rates are going, that might also be important, but we're not expecting any significant changes. Why do we think interest rates are going to be left on hold? Well, we think the Bank of England remains relatively cautious. The last decision was only 5-4 in favour of a 1/4 point cut in interest rates. And for that majority, those 5 individuals who voted for a cut, the decision was said to be, for some of them, finely balanced. And Governor Bailey, who was one of the people who voted for a cut in August, he was in quite cautious mood, I thought, at Jackson Hole quite recently. He was saying, don't cut too aggressively and too quickly. The job hadn't been completed in getting inflation sustainably down to target. And therefore, it doesn't feel like he's racing to cut interest rates. And the same with the data. The data has sort of been a bit mixed. They're all watching the labour market data, but there's a little bit of, I don't think they have a huge amount of confidence in the labour market data at the moment, and they're quite mixed. GDP numbers were quite mixed. So I think they're just staying a little bit cautious, keeps interest rates on hold, come back in November and see where we are.
Thinking about the broader picture for the Bank of England, do you think this cautious stance that they've had, or that we think they're going to keep at this meeting next week, do you think that's something that can be lasting? And if so, what do you think that means for sterling?
Yeah, we think it can be lasting. I sort of hinted about terminal rates maybe being a little bit higher in the UK than markets have priced. We think interest rates are coming down, but we think that they cut interest rates early next year, but then they're done at 4%. Markets are a little bit more confident that they continue to go down. And when I look at our projections for the Bank of England relative to either the US or other G10 currencies together, sterling is going to find that they, or can find support from a positive carry between the UK of sort of 1% on average. And if I look at the relationship between sterling and interest rate expectations, that would tend to support the idea that, for example, sterling dollar would be drifting higher over the next quarter and a couple of quarters. So I think that matters. And the other thing I think also matters for sterling is this sense of political stability. It's something that I was talking about, and a lot of people, to be fair, at the beginning of the summer. That's faded a little bit, but I think that's a slow burning support. When we think about maybe political instability in some other regions, not most obviously in Europe, I think maybe UK assets might be a little bit attractive. So I was actually I was recording to a couple of colleagues one of my favorite books as a child, The Hitchhiker's Guide to the Galaxy. I'm not sure that every reader or watcher on this will remember it, but there's two bits out of that. One is the no panic bit on the front of The Hitchhiker's Guide to the Galaxy, and the other one is mostly harmless, when they're describing the world. And I actually think when I look for sterling in the UK over the next 6 months, don't panic, mostly harmless. Rates are going to be supportive, maybe growth, political stability. So I still hold to my view that sterling dollar ends the year higher and drifts a little bit higher in the beginning of next year. So that's an awful lot on Europe, ECB, Bank of England. Not the most exciting set of rates calls, but I think going forward, there'll be a little bit more to it. Obviously, I mentioned that debate in the US between the Fed, would they go 25 as an opening cut in rates of this easing cycle, would they go 50? We had a little stronger than expected core inflation numbers. I mean, has that finally sort of put the balance of risk in favor of a quarter point, or do you think 50 is still possible?
Yeah, we think that this has probably settled the debate on 25 versus 50 in favor of 25. And now, look, we were still in the camp of 50 basis points heading into those numbers, thinking that we could still make the case for moving more aggressive in this easing cycle because of the downshift we have seen in the strength of the labor market, that the US policy rate is well above neutral. And the unemployment rate, generally speaking, maybe not in the most recent data, but broadly speaking, has been moving higher. And if you look at things like hiring pace, JOLTS job openings, we're effectively back to pre-pandemic levels. And so with the labor market effectively at levels that are more consistent with where we were before the pandemic, and inflation generally showing progress, we think there's still a case to be made that the Fed could look to be a little bit more aggressive at the start of this cycle. Now, it sounds like the Fed is going to find themselves in an if it ain't broke, don't fix it type approach to September, which is something much more clearly has to be effectively going wrong in order to justify 50. This inflation number this week, core inflation coming in a touch stronger, that probably leans into some of those concerns from Fed officials about maybe moving a bit too aggressively too early. And so it probably means that those members are going to be okay with just starting the easing cycle at 25 basis points. Now, when you look through the details of the CPI print, one thing that stands out to us is that some of the strength in the CPI comes from categories where summer seasonality may have played a role. Things like lodging away from home and airfares, where you tend to have, summer travel season maybe having a bit of an outsized impact. Now, I don't want to get into the game of explaining away inflation we don't like and sort of pointing towards, better days down the road. That's something that has tripped up a number of, a number of, economists, strategists, and even the Fed themselves, right? But we still think that the path forward for inflation is to the downside. And for the core PCE deflator, which is the Fed's preferred inflation measure, the feed through from the CPI and also the PPI this morning, we're probably looking at a lower advance, a slower advance than we did for the CPI. So closer to a 0.1 than a 0.2, which is what we got in the CPI this week. So we still think the case will be able to be made for more aggressive cuts as we move later into this year. And so we still think that there is room for the Fed to speed up the easing cycle if we continue to get slowdown in the pace of hiring, continues uptick in the unemployment rate. But it does feel like that for this meeting in September, the balance of risks, and it seems like where the Fed wants to find themselves, does seem to be pointing towards 25 as the first move.
So we had that important CPI number. We also had a presidential debate. I thought that was a super interesting debate. So I'm keen to see how did it change anything for you in terms of the race for the White House in 2024?
It did and it didn't. So let me back up and sort of explain myself here. Uh, we came into this debate seeing Vice President Harris with a lot of momentum coming out of the summer ever since they changed over the top of the ticket. And we were looking at this debate as a moment where Harris could either solidify that momentum or whether or not voters would not like what they see with Harris, both in contrast to Trump and in contrast to Biden, who we saw earlier really struggled in the debate. So Harris was riding this wave of momentum, but a lot of her policies were not yet, formally rolled out. Her campaign is very truncated, and her big momentum push has happened during the summer when, frankly, not a lot of people are paying attention. And so what we were watching in the debate was, will Harris advance the ball or will she fumble the ball as the NFL season kicks off? And I don't think she necessarily did either, but that was probably enough. The sort of exit polls we have seen, and the sort of general discourse in the aftermath of the debate was that she was the quote unquote winner of the debate. She didn't necessarily, I think, push anyone away. And I think she performed well enough to sustain that momentum. And betting markets have moved similarly in that direction. Notably, as we look across FX markets, the impact was relatively small. And certainly we had other drivers. Certainly the whole macro picture is unfolding as we're watching this debate, right? The debate happened, and then we had CPI and PPI as well. We had the ECB. We are in the midst of a transition of the monetary cycle, which is, I think, playing first fiddle for the dollar. The debate and politics is still kind of playing second fiddle here. But as we were watching the debate live, the dollar was edging slightly lower on balance as we were observing betting markets moving slightly more in favor of the vice president, Kamala Harris, and slightly lower for Trump. Now, you can't put too much into a 9, 10 p.m. move in Eurodollar, in a couple of hours ahead of a big US CPI. But that is consistent with the direction that we think the dollar would move if we were to get a Harris presidency. So I think that is worth noting, that our expectation is that Harris outcomes, Harris victory scenarios are probably the lower dollar scenarios, simply because they imply pricing out of potential Trump related strength in the dollar, thinking about things like additional fiscal stimulus potentially, higher interest rates potentially. What does that mean for the Fed cycle? Can the Fed be more aggressive if the market is concerned about higher inflation coming from additional fiscal stimulus or from additional tariffs? Trump also is, pushing that America first style trade and foreign policy, which we think is something that maybe widens growth differentials away from towards the US, simply because of the downside risk it presents to the world's, say, manufacturing sector or economies where exposure to exports is a lot stronger. Paul, you mentioned European manufacturing and, industry. When Germany is an economy where it feels like there could be potential downside risks if we're revising down global growth expectations, revising down manufacturing growth expectations because of potential tariffs and trade war risks. So we see a number of different avenues through which a Trump presidency would lean towards a stronger dollar. And if we're pricing that out on election night on a Harris victory, that could mean a weaker dollar through November 5th. So interesting to see that the dollar was selling off modestly as we were watching the polling, the betting odds moving in Harris's favor. So that's a notable thing as we look ahead, maybe a bit of a preview for how the market is trying to handicap these as far as the dollar. Although, as I mentioned, it does feel like, because we're in this transition mode in the monetary policy cycle and we're still debating 25 versus 50 for the Fed, the broader pace of easing, and also the endpoint of this cycle. One thing I didn't mention when we were talking about the Fed is they're also going to be releasing that dot plot of expectations for the policy rate, not just for the end of this year, but really through the next couple of years here. And that's going to be super important because, as you mentioned, Paul, terminal rates, not just where the cycle begins, but where the cycle ends, very important. The Fed right now has a longer run estimate of 2.75% as the median. I think most in the market think that number is probably a little too low. Say that number is revised up in the dot plot if we were to get it in September, maybe that tempers expectations for for how deep the easing cycle will ultimately go. So a lot of interesting things, sort of first fiddle drivers for the dollar, I think, in the near term, but interesting to see the dollar reaction as we saw Harris's odds moving higher. That's generally consistent with how we're thinking about how the election could impact the dollar.
Yeah, it definitely seems like there's going to be a lot of important cross currents for the dollar as we go into the end of the year, and how they build crucially through into 25. He's talking about the Fed. You've got that big policy divergence potentially in the White House, and lots of geopolitical concerns. So I think it's time for you and I to start sitting down, thinking about the year ahead themes that seems to be coming around super quickly, and I'm sure we'll be talking about those before we know it.
Absolutely right, Paul. So with that, I think we have covered a lot of ground today, and we'll have a lot more to say over the coming weeks as we assess where these easing cycles are going and how changes in the political backdrop may or may not influence those. So to our listeners, thanks very much for listening to today's episode. If you enjoyed the podcast, please consider giving it a like and subscribing to our channel so that you can get our latest content the moment it's released. Thanks very much.